Hey guys, Max here, and yesterday the market took a turn for the worse. Stocks fell across the board, investors weren't happy, and it kind of seemed like it came out of nowhere, so we're going to examine exactly what happened. Now literally, what happened in the markets? Well, US equities fell for the most part, as you can see on this map. Tech in particular did really poorly, with small cap tech doing quite awfully, but to be honest, most of the market fell with that. The main sectors that didn't fall were healthcare and consumer defensives. Why did healthcare do relatively well? Well, probably because China is seriously struggling with COVID right now. They've shut down Shanghai in its entirety, put the whole city into a full-on lockdown. Videos are emerging of the military arresting people and forcing them into quarantine camps. It's quite literally 2020 all over again there, and there is a new variant in China that might be the cause of all this, so investors and markets reacted to that a little bit. To be honest though, I think that's probably a bit premature. New variants have been seen time after time so far, and never before have they turned out to actually be the game changer that the media has claimed they will be every time. But we do know for a fact that Sinovac vaccines that China produced and gave out to its populace were awful. They never worked well at all, and against Omicron in particular, they literally didn't work. We also saw consumer staples or defensives perform well, companies like Walmart and Costco, and that's because there are lots of fears surrounding a recession right now, and these companies are usually able to weather recessions quite well because their sales represent essentials that people either frequent no matter what, or they represent cheaper or discount stores that actually perform well during recessions as a whole. So on the whole, the S&P fell by 1.2% and the Nasdaq fell by 2.3%, so not a strong day for US markets at all. Now bonds saw a pretty massive rout as well, with the huge yield increases all over the world. The US 10-year Treasury rose 16 basis points in one day. That is absolutely crazy volatility for bonds, and as a result, the yield on the 10-year has reached a new 3-year high of 2.56%. German and British 10-year bond yields rose too by 11 basis points each as well, with the exact same thing going on over there. This kind of volatility in the bond market should not be ignored at all. It is very worrying. Now, surprisingly enough though, we did see oil prices fall, which as always is nice. WTI crude fell by 3% and it now sits just above $100 a barrel. Brent crude oil, as always, is sitting a fair bit higher at $108 a barrel. Gold stayed pretty consistent, currently sitting at $1,924 an ounce. Really no movement there to speak about. So why did equities for the most part perform so poorly, especially if oil prices fell? Well, if I say it's because recession risks are mounting, inflation is sky high, and the Ukraine war is continuing, I would be right. But those things have all been true throughout the entirety of the rally we saw over the last month, and the market just ignored them then, so why is it being paid attention to now? Well, frankly, the real reason the market fell is because investors are stupid and have the memory of a goldfish, and they forgot that the Fed is tightening the monetary environment. Yesterday then, we heard from Brainard, the Federal Reserve Governor, and she said that the Fed will continue to tighten its policy, and it will even go on to shrink its balance sheet as soon as May, which means the Fed will be selling bonds instead of buying them. That is quantitative tightening, and that will completely change the financial environment. It will be the Fed removing liquidity from the markets instead of adding it, flooding the market with their completely mispriced assets, sending bond prices crashing and yields soaring. Suddenly, almost overnight, investors just randomly remembered that inflation is ridiculously high and the Fed has no option but to raise rates and change how they've been operating. So all at once, investor sentiment changed and markets fell. Now, this is entirely irrational. It's absolutely insane that the markets as a whole, that millions of institutions and individuals all selectively remember certain things because they want to make money. This is the result of 14 years of quantitative easing though, 14 years of money printing, of unchecked bull marketness that isn't based on the innovation that the internet has allowed us to capture, but it's actually all based on the actions of central banks around the world. The best way I can really explain this is that the further detached the markets get from the economy, the more derivatives are traded, the more leverage is used, the more money there is in this system, the higher markets pump. But of course, that turns into a bubble and it always crashes at some point. This time, it's not any different. This graph here shows us just how detached our markets have become. There has never been such a huge difference between the size of the American economy and the size of the financial markets that are supposed to be inherently supported by that economy. This is not sustainable and it will end at some point. Now, some people are also claiming that the markets fell because of the war in Ukraine and the developments regarding that. But again, I disagree with that one for one pretty simple reason. Those developments being the war crimes committed by Russian forces that have been exposed since they retreated away from Kiev, well, that all came out before yesterday, and yet the markets rose on Monday only to fall on Tuesday. Some people are therefore claiming that the market is actually reacting to the increased likelihood of sanctions being levied against Russia. But again, news of these sanctions started coming out on Monday, not yesterday, and the markets just ignored them on Monday, only to rout on that same news later on a day later. This just doesn't make any sense. The real reason for this rout is investors and their sentiment playing off of other investors and how they're feeling, and as a result of that, everyone gets caught up in the hype and despair really easily, so we see quick changes and really sharp crashes followed by really aggressive rises, none of which were ever really warranted. All I can say is to try to ignore what other investors are doing when looking at your own portfolio. Make and scale your bets on data, intrinsic truths that don't change day by day according to whatever Bloomberg or CNBC are pushing at that point. Don't trade on emotion. Don't get caught up in following the crowd. Just buy assets that you think are reasonably priced and will do well in the future. Hold them long term, and really, you can't go wrong. Now, as a really quick off-topic note, I get a lot of people asking me for advice on how to trade their portfolios, and my position is always, I can't help you, I can't tell you that because you and I are not the same. We have different needs, wants, risk tolerances, and everything else. But I am putting together a symphony with Composer that is basically just my trading strategy that other people will be able to invest in as well, and I'll be putting my own money into it as well, of course. That will hopefully be announced within a few days, so keep an eye out for that. Now, as always, apparently there is more news from Elon Musk regarding Twitter, Jack Dorsey, all of that stuff. Of course, this story is not about to just end overnight, so I will have a short video out later today just explaining what those new developments are and what exactly is going on, so make sure to look out for that. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, so if that sounds interesting, then make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you get from any savings account these days. Thanks for watching, stay stoic. Until next time.